Hi everyone, I'm Tim Hill, a registered mortgage broker based in British Columbia. With years of experience guiding clients through the ups and downs of the Canadian housing market, I've seen firsthand how economic forces can make or break your mortgage plans. Today, we're tackling a hot topic, inflation, and its profound impact on mortgage rates. Whether you're buying your first home in Vancouver or refinancing in Victoria, understanding this connection is key to making smart decisions. In this video, I'll break it down step by step: how inflation is measured, what causes it, the Bank of Canada's role in taming it, and how it influences both fixed and variable mortgage rates. First, let's demystify what inflation actually is and how it's measured. At its core, inflation is the rate at which the general level of prices for goods and services rises over time, eroding purchasing power. Think of it as your dollar buying less coffee or gas than it did last year. In Canada, the primary way we measure inflation is through the Consumer Price Index, or CPI. The CPI tracks the average price changes for a basket of common household items, things like food, housing, transportation, and healthcare. Statistics. Canada updates this monthly, calculating the percentage change from the previous year. For example, if the CPI rises from 100 to 102 in a year, that's 2% inflation. There are variations too. Core CPI, for example, excludes volatile items like energy and food, giving us a steadier view of inflation. And then, there's the Bank of Canada's preferred measure, which aims for a specific target range. But hey, we'll get to that pretty soon. So, why does this matter for mortgages? Well, high inflation can push up costs everywhere, including borrowing, which ties directly into rates. Pro tip here: as a broker, I always advise clients to keep an eye on CPI reports. They're publicly available and, honestly, can signal where rates might be headed. Now, what actually causes inflation? It's not just one thing. Economists usually point to three main types: demand pull, cost push, and built-in inflation. Demand pull happens when consumer spending outpaces supply. Imagine the economy booming. Jobs are plentiful, wages rise, and everyone wants to buy homes, cars, or vacations. If production can't keep up, prices go up. For instance, post-recession recoveries often see this, leading to inflationary pressures. Cost-push inflation comes from rising production costs. Think oil prices spiking due to global events, or supply chain disruptions increasing the cost of raw materials. Businesses pass these on to consumers, creating a ripple effect. In British Columbia, where we rely on imports for many goods, this can hit hard. Built-in inflation is like a self-fulfilling prophecy. Workers demand higher wages to keep up with rising prices. Companies raise prices to cover wages. And the cycle continues. It's often tied to expectations. If people think inflation will rise, they act in ways that make it happen. These causes aren't isolated. They interact. And when inflation gets too high, say, jumping from a stable 2% to 5% or more, it can really destabilize the economy, which is where central banks step in. Speaking of which, let's talk about the Bank of Canada's pivotal role. The BOC is Canada's central bank, independent from government, with a mandate to promote economic stability. Their key tool? Controlling inflation through monetary policy, targeting a sweet spot of 2% annual CPI inflation within a 1 to 3% range. How do they do it? By setting the overnight rate, the interest rate at which banks lend to each other short term. If inflation is heating up, the BOC raises this rate to make borrowing more expensive, cooling demand. Conversely, if inflation is too low or the economy sluggish, they cut rates to stimulate spending. For example, suppose inflation creeps up due to strong demand. The Bank of Canada might hike the overnight rate from, say, 2% to 3%. This change ripples out. Banks' prime rates rise, affecting everything from credit cards to mortgages. They've also used quantitative easing, basically buying bonds to inject money into the system, or tightening to pull it back. In British Columbia, where housing is a big economic driver, Bank of Canada decisions hit close to home. As a mortgage broker, I monitor their announcements closely. They meet 8 times a year, and honestly, each one can sway the market. Finally, here's the heart of it: how inflation affects mortgage rates, specifically fixed and variable ones. Mortgages are long-term loans, so rates reflect both current conditions and future expectations. It's really important to keep this in mind when you're making those big decisions. All right, let's dive into variable rates. These are linked to the lender's prime rate, which, as you might expect, closely follows the Bank of Canada's overnight rate. Now, here's the thing. If inflation starts to rise, and the Bank of Canada decides to hike rates to keep it in check, your variable mortgage payment could see an increase. For example, if the prime rate shifts from 4% to 5%, a variable rate at prime minus 0.5% would go from 3.5% to 4.5%. This could bump up your monthly payments on a $400,000 loan by, well, potentially $200 or even more. But here's the upside. When inflation cools down and rates drop, your payments will decrease automatically. So, let's chat about the pros and cons of variable rates. They're fantastic if you expect rates to fall, but, they do carry some risk. Payments can fluctuate with the economy, so it's something to keep in mind. Now, let's move on to fixed rates. These are locked in for a term, say 5 years, and they're based on government bond yields. Bond yields tend to rise with inflation expectations because investors want higher returns to offset the eroded value of their money. So, if the markets anticipate inflation climbing from 2% to 4%, bond yields might jump from 3% to 4%, which would push fixed mortgage rates up in a similar fashion. So, fixed rates offer predictability. Your payment stays the same, shielding you from short-term hikes. But, if rates fall due to controlled inflation, you might miss out unless you break the mortgage, and that usually comes with penalties. So, in general, during high inflation periods, both rates tend to rise, which, makes homes less affordable. Now, when inflation is low, rates usually ease up, boosting your qualification. Here in BC, with our speculation tax and those high prices, this whole dynamic really gets amplified. Higher rates can slow the market, while cuts often spark some pretty big booms. As your broker, I help you weigh fixed versus variable options based on your risk tolerance and, of course, your outlook on inflation. For example, if it looks like inflation is going to stick around for a while, locking in a fixed rate might just save you some stress down the road. All right, to wrap it up, inflation, which is measured by the CPI, comes from demand, costs, or even expectations. The Bank of Canada fights inflation with rate adjustments, and that directly influences variable mortgages through prime rates and fixed ones through bonds. Understanding all of this really empowers you in the mortgage game. Thanks so much for joining me on this deep dive. If you're in BC and ready to talk about how inflation could affect your mortgage, just reach out. I'm here to help. You can visit my website or give me a call for a no-obligation chat. And hey, don't forget to like, subscribe, and turn on notifications for more insights. See you next time. Stay informed. Stay ahead.